All right, let's start. Do you have any questions? All right. So, first order of business is the exam on Friday, which, as I announced, will be using responders. All right. So here will be the setup of responders on the exam. So there will be two instances of the midterm. All right. So one with responders and one without. Okay. You're supposed to do the, you're supposed to work with the one on, you're supposed to work on the one with responders. Okay. You're supposed to work or take the test, right, on the one with responders. After you're finished, then you can exit and then submit with the other one. The reason is responders will lock down the browser, so you will not be able to, take picture and then upload the file and submit, with responders on. Okay, but on the other hand, I need to have a record of you taking the exam being proctored. So responders, right, is required while you're taking the exam. So you need to work on the one with responders. And for that matter, right, there are two difficulties, the one with submission. So submission will be taken care of by the one without responders, and I'll label them so. The other one is the opening the file, but it's not a difficulty. It's just people don't know where to click. So to open the exam file, okay, which is, you must do this under responders, okay? Because if you open the file and you open responders, you cannot keep the file open. To open the exam, on responders, click on the magnifying glass icon next to the link. Okay, so many people try to click on the file link and they say they cannot open the file. Uh, you're supposed to click on the magnifying glass icon, okay? And I'll post a picture, a screenshot of the responders, and then highlighting the icon so that you can click on the right place. All right. But so these are the instructions for the exam with responders. Any question on this? Okay. So then that's out of the way. Let's continue with our lecture. So last time, so we proceed from different from a Black-Scholes model under the physical model, where we have the rate of return of the rate of the percentage return is mu, and the Brownian motion is denoted as W, and the percentage return under the risk neutral framework, okay, is R, and the Brownian motion is denoted as W tilde. Okay, so this is the risk neutral model. Okay. So the two differences, right? One is the rate of return here is R, and the rate of return is mu. Notice they have the same sigma, okay? They have the same volatility. So different rate of return, rates of return, but same volatility. This is quite important. Moreover, the relation, right? The relation between W and W tilde is, you can see that WT is WT, let's say this, right? Plus mu minus R over sigma dt is dW tilde T. Or in other words, right, WT plus mu minus R over sigma dt is dW tilde T, is W tilde T. And this, sorry, not dt, right, T. This quantity is referred to as the Sharpe ratio. It basically tells a better picture, right, of the stock. It's the normalized version of the return, of the excess return of the stock, right? If you look at the excess return compared to the risk-free rate, and then you normalize by the risk factor, right, the volatility, then that gives you a normalized version of the excess return of the stock. And so this relation is the connection between the physical and the risk neutral model. And it will play a role in deciding whether risk neutral probability exists, as we'll show. Okay. So after we set up all this framework, we can look at the call option. On the stock, where we say the value of the call option is ST minus K plus. And so the risk neutral pricing says that V0 is the risk neutral expectation. Okay, like this. Now, if you apply the model, okay, if you apply the model and you work out the expectation, right, the Black-Scholes formula says this is going to be S0 ND plus minus K e to the minus RT ND minus, where D plus minus is R plus minus 1/2 sigma square T minus log, this is natural log, K over S0 divided by sigma square root T. Okay, so that rounds off the whole kind of story about risk neutral pricing under the Black-Scholes model. But on the other hand, there are a lot of things to say, okay, about this model. And we're in the middle of discussing some of that last time. So first, right, several remarks about risk neutral pricing. First of all, right, the pricing, risk neutral pricing on the derivatives of S does not, so let me say this, right? Only depends on R, right? T, the time to expiration, and let's say sigma. Okay. It also depends on K, which is the strike price, but we think of K as like part of the payoff function. So if you want, you can say the payoff function, which is the definition of um, the derivative itself. What it does not depend on is the rate of return, the physical, okay, the physical rate of return. So this leads to some, something that is a bit non-intuitive if you kind of work out some examples. So by the way, right, the reason for this is quite simple. The reason is, so at least, right, mathematically, right, the rate of return under risk neutral framework is R. So there's no mu involved. That's why the pricing cannot depend on mu. Okay, no mu involved. So now if you work out the implication of this, right, there are several implications. The first is this, that so for example, if you have two stocks, right, I think this is on your homework. If you have two stocks, suppose they have the same initial price, they have the same risk factor, and suppose they have different rate of return. Let's suppose that the rate of return of the second company, right, is better than the rate of return of the first company. What this tells us is that any derivative based on the two stocks have the same price. Okay, and this is irrelevant of what the derivative is, and it's also kind of surprising or at least counterintuitive if you think about how the rate of return of the first one is higher than second one. So in some sense, the rate of return, right, the stock A is supposed to perform better than stock B, but the risk neutral pricing doesn't care for that. It says that the derivative on either of the stock would be the same. So you cannot even see the difference by just looking at the derivative price based on these two companies. All right. So, well, how so? Or, like, what is the reason behind this, for example? And again, right, the reason just comes back to the risk neutral pricing that, at, so at the heart of things, all right, so the most basic explanation goes back to, okay, if you look at, let's say, two derivative, the first one pays you one share of stock A at time t. The second one pays you one share of stock B at time t. Then clearly, right, both of these derivative have the same price, which is the price of either of the stock at time zero, because they're equal. Okay. So already here, you can see paradox, if you will, or not paradox, just a counter-intuition, right? That somehow, again, right, you clearly expect stock A to perform better, but then, right, so stock A has a chance, right, has a much better chance to be higher than stock B at time t. But if you look at these two derivatives, risk neutral pricing, right, tells you that they must be equal right now. And then, by the way, right, that's exactly the the explanation for risk neutral, right? When we say stock A has a chance to be bigger than stock B, we're not saying that stock A will be guaranteed, right, to be better than stock B when you think about it. All right. So I mean, all right. So when we say this, right, they may be subject to different noises, for example. Obviously, if they are in the same noise, then stock A will be higher than stock B. But so here we say that stock A has a chance to be higher than stock B. And so for that, right, um, that's a risk statement. It's not saying that stock A is guaranteed to be higher than stock B to begin with. All right. So risk neutral doesn't care about that. It only cares about what's happening, right now, for example, is one of the factor. And if right now you say these two stocks are valued at the same price, then that's what it says, right? That's what the current value of these two derivatives. Another way out of this kind of counterintuition is this, right? That the paradox or the counterintuition, right? The source of the counterintuition is not from the pricing itself. The counterintuition is not from the pricing argument, but right from the assumption that these two stocks currently have the same price. Okay. So do you remember that a big point of risk neutral pricing, okay, as I say, is it's not about telling the market what the right price should be. Risk neutral pricing is very much has the point of view of accepting the price of the market. Okay. In which way? It accepts that the current two stocks are like this to begin with. Okay. It just says that, okay, if these two stocks have the same price right now, then consistently speaking, or like in the no arbitrage framework, then any derivative based on these two stocks must have the same price in the future, currently, as long as they have the same level of volatility. But of course, right, it cannot tell you whether this assumption is right or wrong. That's a market decision. Okay. It just says that if this is true, then this is my conclusion, like consistently. But right, if you really think about it, this is where the assumption is weird, if there's any. In the sense that, right, in a market, if you have two stocks, same level of risk, and one has high rate of return, you could expect, right, that this stock A have high demand, right? People would want to invest more on it. That would naturally push stock A to have higher price currently. Okay. So in other words, this situation where we make this assumption, it seems strange, but not strange because of this conclusion, but strange because of this assumption to begin with. So in other words, this should not be true, but market demand should, right, push this to be true. All right. And if that's the case, then you see, then this will be bigger than this. And then that, of course, your expectation. But on the other hand, right, suppose that really that market really prices two guys to be equal, then there's something there, right, that they see about stock A and stock B that we don't see. It's not captured in terms of volatility and return, for example. So from that point of view, it's hard to say. But if, right, somehow the market decides that these two stocks have equal value right now, right, that's what they say, right? Remember, right, the market is forward looking. They price the current stock, right, based on how they perform in the future. This statement is more meaningful than you think it really means. It's not just a mathematical statement. Financially, it says that the market expects these two stocks to perform the same in the future. That's why they have the same price right now. For that matter, right, you see, then any derivative based on them should, right? I mean, of course, again, there's a risk factor there that should be reflected. But otherwise, right, the return doesn't come into account because of that, okay? And this is a very, very important feature of risk neutral pricing that is well known in Black-Scholes. That is, if you somehow, right, mistakenly use the physical rate of return in your pricing will be wrong. So that's a short message about it. Any question on this? Okay. So the next thing we want to discuss before we, go back to the whole Black-Scholes formula and explore it some more is the question of existence, okay, of risk neutral uh, probability in um, Black-Scholes model. And for that matter, actually, we also discuss uniqueness here. So it's really about, the fundamental theorem of asset pricing in this case. Okay. So it's like this. Uh, First of all, what do I want to say here? First of all, suppose you have a stock like this. Okay, this is a physical model. And let's call the first one A. Okay, so you have two assets. The important thing here is, so two assets, okay? This is two assets, one source of noise, which is, the Brownian motion WT, okay? And this should remind you, okay, of the case of like, compare this with the one period binomial model with two assets. There, all right, our conclusion was that in general, if you have a binomial model with two assets, you should not have a risk neutral probability. The reason is, right, it's overdetermined. The system is overdetermined. There are too many assets for too little noise in terms of the binomial model, right? Only up and down. You'll see that the same thing happens here, but the noise is driven by the Brownian motion. So we should see how things go on that front. The key to the observation here is the same source of noise, okay, for that drives both of the stock. Financially, you can think of this as like these two stocks are in the same sector, for example. I don't know, like they're both like blue chip stock or something. All right. And of course, like this is, let me also tell you that this is oversimplifying the financial model, because even if it's like in one sector, right, there are many, many sources of noise that can influence a stock. Each of them can be represented as a Brownian motion, okay, as you see. But here we're simplifying the model, the story, and suppose, right, to demonstrate the mathematical idea, suppose that there's only one source of noise that drives these two stocks. they're both subject to the same, right, condition. So they are highly correlated, if you will, in this case. Okay, so then the story is this: if, right, if, and this is a big if, as you see that this is not going to be true in general. If, okay, a risk neutral model exists, a risk neutral framework exists, then they both must have the rate of return R, okay, under the risk neutral model. Okay. So the question is this possible? Okay. And what do I mean by that? What I mean is this mathematically possible? Okay. And do remember, right? This is exactly here that, I emphasized last time that the transition from physical to risk neutral is not simply wipe this out and write an on thing. All right. It is a more subtle, okay, transition that move the Brown motion W to W tilde, okay, via, you know, this quantity right here. So basically, right, to move from physical to risk neutral, you must attach, all right, a sharp ratio rate of return to a Brown motion of the physical model. So that's the key here, okay? To answer whether this is possible, we want to look at the transition, because here, right, unlike before where there's only one transition, here you have two transitions. But the point is this: it's the same Brownian motion here, and it's the same Brownian motion here. So you are saying, if so, okay, then Wt plus sigma mu a minus r over sigma a is W tilde t, and Wt plus mu b minus r over sigma b t must be W tilde t. Okay, because these two equations capture the transition from here to here and here to here. Okay, so what do we see about this? What do we see about this? We see, right, that if that's the case, then that must be that the Sharpe ratio of these two companies must be the same. All right. Now, if you look back into the one period by node model, right, it's not that we say that with two assets, we say that risk neutral probability always does not exist. We didn't say that. We say if you revisit that situation, you see that these two assets must somehow be compatible in a certain way, right? The U1, U2, and D1, D2 must kind of have the same proportion. And that proportion actually now is reflected via the Sharpe ratio in the Black-Scholes model. Okay. So in other words, right, that unless these two companies are so special, right, that they have the same Sharpe ratio, you could not model the two stocks in the same market like this. Or you could say that this model is inconsistent, or there's no risk neutral probability. Okay, if this does not happen, if this does not happen, if this does not hold, then the Black-Scholes model with you know, two assets, one source of noise is not arbitrage free. Okay, so that's the condition. Many questions here. All right, so you see, this condition also has a lot of meaning in terms of our financial context. Well, again, right, a market is arbitrage free, if a risk neutral problem exists, or basically it's the model, the place where we can just do pricing as we usually do. The below analysis shows us that, right, if you only have one source of noise, then it better be that these two companies are the same in terms of their risk factor, right? Here, right? Remember how I said, right, the Sharpe ratio is like a risk measure of a company, right? An investor would not necessarily pay attention to the rate of return, to just volatility, right? But in exactly this is the normalized excess return. So if you look at this, right, then an investor from this risk angle point of view would be indifferent whether they invest in A or in B. So in that sense, it says that if with one source of noise, right, what it ultimately means is you cannot diversify your risk too much because there's only one, one brand motion here. Then these two stocks, right, these two companies better be kind of like the same company from the risk point of view. Okay, so it really, that condition boils down to that these two companies, to avoid arbitrage, okay, to avoid arbitrage, these two companies but better be the same in terms of their risk factor. That's what it says. Okay, and that makes perfect sense. Okay, now, so what's the way out, or what other model we can propose? So this will not be something we consider so much in this class, but it's possible, okay, to consider Black-Scholes model with more than one source of noise, or more than one Bragg motion. Okay, it goes like this. Suppose you can do this. Let's revisit our story with two sources of noise. So DSAT, let's say, is mu A plus, let's say, sigma A1 W1 plus sigma A2 W2. Okay, and let's also do the second one, but let's say, suppose the second one, oh, what am I saying? Sorry, I'm not even paying attention. I'm not posing the model correctly. Mu A SAT DT, okay, and then this SAT DW1T, and then sigma B1, sigma 8 A2, okay, SAT DW2T. All right, and suppose that stock B only has one source of noise. And let's say what is one of them. So let's say it's the first one. Okay. And this is again a perfectly viable model. If anything, it seems a little uh, more realistic than this one. All right. It says that, right? So now you see that stock A and stock B are less correlated because stock A, right, has an entirely, oh, by the way, I should say this, right? W1, W2 are both Brownian motions, but they're independent. Okay. So they are different sources of noise that feed into the return of the stock. Okay. And here, right, you can tell whatever story you want, but maybe they are in the same sector. So this is the sector common, sort of source of noise, but the first company have some other, specific risk factor that is exposed to. I don't know, like let's say, this is I don't know, like a ride share company like Uber, right, who is subject to some other condition rather than like a blue chip company like, let's say Apple or something. All right. So anyway, the point is that, right, that there are two sources of noise possible in the model that drives the whole kind of up and down, okay, of the return of the stock. What this means here, though, right, seems like there's more risk uh, in the model, which is really not true, okay? The reason is, risk is measured by A, volatility, B, this kind of condition. And so what's actually happened is this is richer in the sense that if an investor want to diversify their risk, all right, if an investor want you again, you think of like actually putting money down in investment, right, is a well-known thing in finance that you do not want to invest in stocks that are highly correlated because then it either swing all the way one way or all the way in the other way, right? Diversification means that you want to invest in stocks that, or assets that move in opposite directions, okay? Or at least have tendency to move, not correlating with each other. Then exactly this model or this market that we're proposing has better diversification opportunity because of the two Brownian motion component, okay? Here again, right, the one single Brownian motion component does not open up for too much diversification. Because when you think of it, right, investing in the stock A exposes you to the same risk factor as investing in stock B. So an investor clearly, right, would just want to invest in one. So that also kind of hint at why, you know, um, arbitrage opportunity is very likely in this model, where you can see that arbitrage opportunity is much less likely here. Okay. So again, right? So that's the story about risk from a financial angle. If you want to translate this, okay, into the mathematical formulation, all right, then we view it from a risk neutral point of view. So risk neutral, all right, does the risk neutral model exist? Okay, same question. Okay, if so, right, then again, same story happened. The return, right, changes to R. The volatility gets kept the same. The Brownian motion changed to the risk neutral version. Okay, right. And so again, right, Then now we will want to investigate what it costs or what it takes to go from the physical version to the risk neutral version. Or in other words, what's the relation between, these guys and the risk neutral, right? The W and W tilde. So this implies, right? So again, I think, right, just basically rewrite each of them and then analyze the transition, right, from physical to risk neutral. Okay, let's take the B one first because the B only has one source of noise. It's easier and it's clearer. In general, actually, you will see you have a system of equation to solve. But here, okay, if I start out with the physical model, okay, and I want, right, that the rate of return is really R, then that means, right, that I must add subtract R. In other words, I must have this. Okay, in my compensation. So this subtract R, right, exactly cancel with this. This mu B, right, notice everything get canceled with this. Oh, sorry, right, I should call sigma B on top. Right, this mu B right here exactly put the mu B back. Okay. Now, you see, compare this with this, or rather, right, this with this. You see that's the relation between W1 and W tilde 1. Okay. In other words, right, the relation is W tilde 1 is W1 plus mu B minus R over sigma B times T. That's easy. That can always be done. Notice there's no tying, right? There's no, at least not now yet, right? There's no such thing as both of this has to happen at the same time, that kind of stuff. Right? For us here, the transition, if we just single out the stock B, is quite simple in what it says about the first source of noise. Okay, it says that the first source of noise, right, is going to be the physical version plus the Sharpe ratio of firm B. That's all. That's all there is. What about firm A? Okay, firm A again, right, is a little bit more complicated, but let's start from the physical version where it is mu A, the first one, and then the second one, sorry, sigma A2. And again, right, we want to make this into rate of return R, rate of return R, okay? So here, right, you also know that this must be the first Brownian motion. So let's just do that, right? So it's a first Brownian motion, so it's going to be W tilde 1, right? It will be W tilde 1. So if you want W tilde 1, let's put it there first. But then what do you need to compensate? All right, what do you need to compensate? Notice that first of all, right, to go from W tilde 1 to W1, you must subtract, right? You must subtract this. So subtract mu B minus R over sigma B dt. Okay, this is what we found for W1. Okay, so then everything else must fall on the W2 then. So in other words, sigma A2, right, SAT. Okay, now it's time to collect terms, right? First of all, you put an R here, but where is a mu A? So you better give it back. So in other words, right, there's a mu A minus R over sigma A times dt. Okay. This is to give back, right? The mu A right here and cancel out the R. But then on the other hand, you also have this term right here that you put in, right? So 1 second, let me see. Uh, 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 yeah, you have this term here you want to put in because, right, what happens is this. You want, right, the final model is only W tilde 1 and W tilde 2, right, for the stock A. You only want W tilde 1, W tilde 2. So actually, you don't want that term here to begin with because the final risk neutral model should be only W tilde 1, W tilde 2. So you better you better put that, you better cancel that term out too. So in other words, right, you must add, right, you must add, right, what is this here, right? Sigma, sorry, this is sigma A1. Sigma A1, okay. So you subtract this term, right? So you better add that term in. So in other words, you must add mu B minus R over sigma B, okay? And then divide by sigma A2 times sigma A1. Because this will cancel with this, and this whole term right here cancel with this whole term right here. Okay. Finally, then you give back your W2 like that. Okay. Any question here on this whole kind of complex transition? But it's really just kind of, add and subtract and matching terms. Okay. The point is this, again, the point is to transition from the physical to risk neutral. Okay. To transition from physical to risk neutral. Basically, the basic routine. Yeah, thank you, Jacqueline. We need DT. Thank you, appreciate it. So yeah, DT. Yeah. So the basic thing, right, is exactly that you want to have a risk rate of return R. Okay, you want to have a rate of return R. So in that sense, right, the whole prime motion, right, takes on whatever factor that is sort of like Sharpe ratio for you. And then, the engine behind the scene is the Gasanov theorem that we do not discuss, that somehow transition, right? The Brownian motion would drift into its cousin, which is the risk neutral version. The point is this though, and never mind the complex form. The point is this is entirely doable. This is possible, meaning there's no equation to be solved. Okay. Unlike, because this is just what we call W2. Okay. Unlike the previous case where I say that these two must have their Sharpe ratio being equal. Here, there's no such thing. Okay. Here, there's no such thing. First, the transition, right, from W tilde 1 to W1 involve the Sharpe ratio of from 2, from B. And then from A, right, just inherit that because it says that the first Brownian motion must follow that rule. And then from A, kind of have to kind of modify the second source of noise based on its own Sharpe ratio in a way, right here. Okay, but that in a complex way, but that's it. But so the math is ugly, I guess. The message is simple, that because you have more room to move around, okay, you have more room to move around, you have two sources of noise. All right, you're not tied into that scenario where you have to match this coefficient. Okay, in a hard way. And so in this example, right, risk neutral model exists. There is a general rule. Okay, there's a general consideration on when and where this exists, but I won't go into that. What the point I want to introduce here is the consideration, okay, between sharp ratio, Brownian motion, and how many Brownian motions are there in the model in terms of, right, the existence. And by the way, also uniqueness, okay, of risk neutral model. So you can also see, right, that basically two sources of noise, two assets have risk neutral. There's an existence. There's also unique because this way that we have been doing so far is the only way. You can verify for yourself that if you strike out one stock, then there is a risk neutral framework, risk neutral probability, but it's not unique because there will be many ways for you to transition, okay, from W1 to W2.1 and W2 to W2.2. There are too many sources of noise and only one asset. All right. So you're too flexible in terms of your risk, that's diversification in some way. All right. So I guess one last short message. The fundamental theorem of asset pricing applies here. All right. To apply it, you need to consider, right, this transition like I showed you here. That's how you consider it. But right, everything we said before also works. In other words, a market, right, with a risk neutral framework, with a risk neutral probability, has no arbitrage. Every asset is replicable if only if the risk neutral probability exists and is unique. All right, that kind of thing. Any question? Okay. So now, having discussed that, right, let's go back to the Black-Scholes formula. Which says that when we have a call option, right, then V0 is S0 ND plus minus K e to minus RT ND minus. So from here, right, we can price many other options. By price, I mean have explicit formula. Black-Scholes-like formula for many other options, right? Many other derivatives. So the put, right, is what we look at from the quiz, and relying on the put call parity, what we concluded was, right, that V0 put, so let me call this is V0 call, right, is K e to minus RT and minus D minus S0 and minus D plus, right? Moreover, okay, I just mentioned this, and there's nothing to write because it's not illuminating, but you know the spread, okay, such as bull, bear, that kind of stuff, can also be priced, Okay. Using Black-Scholes formula. Okay. For example, right? Um, let's say I forgot. So this one right here, K1, K2, K3, where, so this is the payoff, and this is stock, right? Where K2 is exactly a half between this. Is this one the bull spread? I forgot. This is on your midterm, right? Let me see. Does anyone remember? This is the bull spread, right? Oh, you're right. Thank you, Jacqueline. Yeah, there's a butterfly. Yeah, it's a butterfly. Yeah. So for this butterfly, right? The whole point is this, though, right? So the whole point is the butterfly will be what I believe that is uh, it can be broken down, right, into call and put. Oh, dang it. I was thinking the butterfly is on your homework, not on this. 1 second. So butterfly will be, I think, twice of something, something. Give me one moment. Um, so I'm just gonna go off my intuition here. I think it's V call K1 T, right, minus twice V call K2 T, and then plus V call K3T. All right. I put a question mark here. I think that's the right one, but check me on that. Because I'm not trying to talk about replication. Thank you. The point is this though, right? That basically what is V butterfly at 0 under the Black-Scholes model? Well, you see, right? You don't have to plug the whole payoff structure here into the Black-Scholes model to price it, because basically based on its decomposition, you can say this is going to be exactly right. I'm just going to write this, which, you know, doesn't mean much here, but it exactly expressed the idea that, right, each of these guys has their Black-Scholes formula. And that's it, right? Anything that can be broken down into put and call, like the butterfly spread here, the bull spread, the bear spread, right? You can just price them, not like directly, but using what you know about the Black-Scholes formula, and then rewrite them, right, in Black-Scholes style. Um, okay, for the spread. So the use of Black-Scholes, right, doesn't have to be limited to just a call, even though that's the only one they give you as a formula. Any other one can be done with it. All right. One more thing I want to say is this, right? So the meaning of ND minus, okay, this is quite important actually. The meaning of ND minus. In fact, ND plus too, but ND plus is a bit hard to explain within our level. So V, right, call is S0 ND plus minus K e to the minus RT ND minus. First of all, okay, that this formula by itself is quite meaningful, really. Why so? Because what is V, right, call in general? V call is ST minus K plus, right? And you see, basically, the pricing formula says it brings back ST to S0, bring K back to this, right, with the discount, with the weight. So it's exactly, it kind of break up, right, the non-linearity, right? Because if things are linear, right, if the forward option is linear, then it's just like this, okay? So for a non-linear, right, combination like this, Black-Scholes formula says, well, it's kind of pulled back to there, pulled back to here, but unlike, right, of course, it's not linear. So these weights right here, right, these are weights, if you will, from some point of view. They're weights because they are value between 0 and 1, right? They're probability. They're weights that kind of balance out, right, the value because due to kind of like price that convexity, right, that you have for non-linearity, right, in the payoff for the call option. But exactly, right, because of that, these weights have their respective meaning. Okay, and here we want to kind of highlight the ND minus, which is very, very easy to say. What is ND minus? Well, okay, the meaning of ND minus is like this. And to do that, we play with this expression. So V call T. So V call T, right, is ST minus K plus, which is ST minus K, and I'll introduce this indicator function that ST is bigger than or equal to K. All right. So this indicator function is very, very popular in probability. What it says is of some event will be 0 if E does not happen. 1 if E happens. And if you pay attention, that's exactly what ST minus K plus does. If ST bigger than K, then it can be ST minus K. If E does not happen, meaning if ST is less than K, then this is 0. So this indicator function, all right, capture exactly what the plus function does, the max function, the max between x and 0 does, okay? On the other hand, there is something about probability that does this. Okay, let me change this to A, all right, because I'm going to use E as expectation soon. So let me change it to A for an event. Now, on the other hand, it has a very special property like this. If you take expectation of an indicator of an event, what you're getting is a probability that that event happens. Okay. Why so? Well, again, it really comes from the definition. Expectation means you average things out, right? Expectation of random variable means you average that random variable out over the value it takes and, right, the probability that it takes on those values. But here, right, this random variable, right, is a random variable because A is a random event. Okay, where here the random event is that you expire in the money. Your option, the call option expires in the money. So right here, it just says that the random variable is 1 if the random event happens. So that's it just exactly takes on the 1 value. And if 0 otherwise. So basically it doesn't it does not count, right, where A happens, what A happens, it doesn't do anything much. It just takes exactly one value. So it comes out to be the probability that A happens. Okay. Well, this identity can do wonders for you. All right. In particular here, let's see what it does. So V call 0 is expectation of e to minus rt st minus k plus, okay, which is equal to expectation of e to minus rt st minus k indicator function, right, of st bigger than or equal to k, as we mentioned. Well, if you break things down, right, well, so basically now we distribute this in, keeping in mind that this guy is a random variable, okay? So that's going to be e to minus rt st st bigger than or equal to k minus k and e to minus rt are constant. They are deterministic, so they can go out. And then you have expectation left. Sorry, expectation under the risk neutral probability. Okay. So this, and then this is probability under the risk neutral measure at st bigger than or equal to k. All right. So this is just working out purely, okay, under expectation, what the call option price at time 0 is from an abstract point of view. On the other hand, right, let's not forget our Black-Scholes formula. Our Black-Scholes formula says this is S0 ND plus minus K e to minus RT ND minus. So now you see why I say, right, that ND plus is a little harder to interpret, because what it implies is this is right here. And you cannot just pull this guy out and say this is S0. It's not like that, because, you know, there's this random variable, okay? But this right here already got matched up like that, because this is e to minus RTK, this is e to minus RTK. So that means this term must be this. In other words, ND minus is nothing but the probability that your option expires in the money. Okay. And I guess let me highlight, this is the risk neutral. It's not the physical one. So how it happens in real life, that's a different story. But this under the risk neutral framework, this is the risk neutral probability that your call option expires in the money, if you just look at the ND minus term. All right. Any questions? Okay. So now this term will show up again in the next one that we're going, the next topic that we're going to discuss. And for that topic, I want to discuss some application of the Black-Scholes model. And this will be some well-known model called the Mertens model for credit risk. Sorry, Mertens structural model. For it's really the risk of a company. I'm not sure we should call it credit risk, but structural model. is this, all right? And the interesting thing about this is it goes away from the stock thing that we're looking at so far, but somehow it utilizes the Black-Scholes model, the core option framework, in a very interesting manner. The story is this: you have a company, okay? You just look at a company itself. A company has three things going on for them in terms of their structure. That's why it's called a structural model. The company has asset, debt, and equity. All right. Equity is a term used in the merchant's model, but for all intents and purposes, you can think of equity as reflected through the stock price. Okay, the stock price of a company reflects its equity. Asset is like everything a company has, like its buildings, its cash, its investment, everything right together is asset. Debt is how much the company owes, right? And usually is connected with the corporate bond, okay, the bond that the company issue to borrow money, okay, from investors. I mean, wow, so there are two things, right? There are investors who invest in the company's bond, and there are investors who invest in the company's stock, right, by purchasing the stock. So here's this. So equity investor, okay, and bond investor. So basically it's this, right, that the company, the model for the structure of the company and by Merton is a very simple model. The company has a debt, okay? This company has a debt, has a debt level, okay? D, that has to be paid at time T, okay? And so you can think of D as like, $1 million or $100 million or something, but it's a fixed number, it's a fixed number, okay? Let's suppose that the company asset, okay? The company asset follows a Black-Scholes model. In other words, the asset, okay, the movement of the asset has a rate of return and has a volatility. Okay. And A0, right, is the company current asset level. Now, what happens at time D? At time D, the company is obligated, right, to pay its debt, D. But again, right, here, the asset, basically how the company operates, right, and generates asset, is subject to a random factor, right? It's subject to noise, shock, whatever. So it's clear that, right, at at time T, it could be that the company has more asset than the debt level, or the company has less asset than the debt level. Okay, both of these are possible. If the company has asset, right, less than the debt, then they have to pay everything, right, to the debt, to the debt holder, the bond holder. So basically, the equity, investor, meaning the one, right, who have equity in the company, has nothing left, or the equity level when the asset, right, is below that level is zero. So another way to say this is you can think of the equity investor is behind, right, the bondholder in terms of priority. The bondholder has to be paid first, and then, right, the equity holder will pay whatever that's left after the bondholder is taken care of. And on the other hand, right, exactly when we say that the equity holders get paid whatever is left after the bondholder is taken care of. This is this statement right here. So all in all, okay, what we're saying is the equity of a company is a call option on the company asset. All right, that is with the strike price being the debt level. So equity, that's Merton's observation, and that's the basis for the whole structural model, or basically the whole connection between how you view a company like a call option. That's the, if you want, the ingenuity of this model. Okay, the equity of a company is like a call option, right, on its asset with strike price being um, the debt level. Okay, so there are many things you once you observe this, right? There are many things you can derive from this. So we can derive many consequences and formulas based on this observation. And by formulas, right, I mean Black-Scholes formula, because exactly we use the Black-Scholes model for the asset growth, and so with this we have everything, right? We have everything that's Black-Scholes model is cooked, is built for. And let me tell you, right, one of the main consequences is this, right? We know what ND minus, for example, ND minus is known, right now at time zero. But what is ND minus? ND minus is the probability that the call option expires in the money. Well, what is in this context, what does it mean for a call option to expire in the money? It really means that a company stays solvent at time t, or it does not go bankrupt at time big T. So this right here, ND minus, okay, can be viewed as a risk measure of the company's performance. Is a risk measure, can be. Okay, e.g., how likely it will stay solvent at time big T. Okay, that's a valuable information to investor, maybe for the bond investor more than the equity investor, because you want to know how much the bond, your bond will be defaulted or not. Okay. Uh, there are nuances, right, in this kind of calculation. For example, the first level of nuance is that this is not a physical probability. It's a risk neutral probability by definition. All right, which makes it a little bit tricky to use because, like I always say, we do not live in a risk neutral world. We live in our world, which is the physical world. So even though, let's say, this computes a number, what use can it be for us who don't live in a risk neutral world? The answer is actually by itself, maybe it doesn't mean much, but you could, for example, compare, right? Using this model, you can compare this risk for similar companies in a similar period. And if, say, for a particular company, this number is relatively high, right, compared to the other companies, the idea here is that whatever happens to the risk neutral world in terms of ranking should be similar in terms of ranking, okay, in the physical world. So if a company has a high risk of default in the risk neutral world, they should also have a high risk, higher than their their peers. Then they should also have higher, right, risk of default in the physical world, and that has a lot of value, okay, to be deduced for you. Okay, there are other nuances. I'll say one real quick, and then we'll be done for today. This asset level here, even though we pose it this way, is not observable. The reason is a company, right, through the stock price, publish its equity level, or you can see what the company's equity is. You do not have direct observation for company asset. So these equations, okay, as we'll explain next Wednesday, gives you an indirect way to observe or to deduce information about a company's asset that may or may not be, okay, publicly available. All right, so again, right, Friday is the exam, and we'll continue on Wednesday, next Wednesday.